NFP is coming this Friday, and the stakes are as high as ever. If you're unfamiliar with NFP, it's a monthly news event where the new unemployment rate is released. It's important to understand how a country's unemployment is trending to better understand the strength of that particular country's economy and currency. Let's recap where we've been before we get to where we're going. In October 2022, the unemployment rate hit yearly highs at 3.7%. The following 3 months, we saw unemployment decline down to 3.4% in January of 2023, some of the lowest we've seen in over a year. Then comes February's NFP report, projected to remain unchanged but instead flew back up to 3.6%. Aaron Terrazas, the chief economist at Glassdoor, a jobs review site, had this to say about the recent uptick in the unemployment rate. Quote, "It's no longer accurate to say without reservation that the labor market is a bright spot in the economy. From 35,000 feet, the picture still looks sterling, but digging an inch beneath the surface, there are clear pockets of softening." End quote. Did you know that you can get 40% off the Edge Finder right now? Our advanced market scanning software, the Edge Finder, was first released 1 year ago in April. So to celebrate, we're doing an anniversary sale. Over the past 12 months, we've helped traders all over the world sharpen their skills and find better trades using the market scanner. This is the best time ever to get the Edge Finder for yourself at this massive 40% discount. Day trader, Edge Finder. Swing trader, Edge Finder. Fundamental or a technical trader, it all comes together in the Edge Finder. So don't wait, because this sale won't last forever. Be sure to take advantage of this 40% off discount at checkout when you use promo code A1YT. Happy trading, everyone. Unemployment, inflation, and interest rates seem to be more critical than ever. If you've been keeping up with the news, you know that inflation has been out of control for a while, but recent interest rate hikes have helped cool off some of that inflation, and currently we see the inflation rate dropping steadily. Now, the main reason I bring this up is because of interest rates. Interest rates continuing to rise is not going to be good for the unemployment rate that just spiked once already. Higher rates means businesses and consumers are less likely to take out loans. Slowing business is bad for the economy, bad for unemployment, and bad for the dollar. What it does do, however, is slow spending, driving inflation down. Elizabeth Warren called out Jerome Powell for his new monetary policy decision, claiming that based on her projections, continuing to raise rates like this could potentially lead to 2 to 3 million Americans losing their jobs. Powell claims that it's a risk he's willing to take because high inflation affects all Americans, and the unemployment rate is the lowest we've seen in a while, and he believes that there's some healthy wiggle room for it to grow without it being an issue. Well, it grew quicker than he probably expected, and his rate hikes aren't done yet. The current projection for Friday's upcoming NFP report is for the unemployment rate to remain unchanged at 3.6%.
This week's NFP numbers will certainly be an interesting one to pay attention to. As of going into this event, in terms of job openings in the United States, we have fallen for the first time since 2021 underneath our 10 million job openings here in the US. The reason that that's kind of interesting is that NFP, and why it matters in a broader sense, is it's all about the Federal Reserve's game plan. Long term, they have a game plan to get inflation down to 2%. And one of the biggest contributing factors to inflation is wages and jobs. When a lot of people are getting hired and a lot of people are getting raises and a lot of people are getting paid more, that transaction contributes largely to inflation as a whole. And so as we go into this jobs number, the Federal Reserve and the money markets in general are sort of forecasting, the money market specifically, are forecasting that rate hikes will come to a slow this year, and perhaps even by the back half of this year, we may even see rate cuts. Now, in order for that not to be the case, in order for a surprise event to occur, It would probably need to see the labor markets, the job markets, and NFP numbers to come out hotter than expected here this Friday and in the coming reports in the next couple months. Right now, markets seem to be forecasting job growth to slow a little bit, and again, job openings being down from where they have been is a interesting leading indicator to pay attention to when it comes to NFP.
Roughly 2 weeks ago, the Fed raised rates yet again, and this will be our first NFP event since the most recent rate hike. We all know what happened last NFP event, and this could be the most important we've had in a long time. Don't forget to check out the links in the description if you want our broker recommendation, access to our free Discord, free Edge Finder, or want to chat with us on Telegram. Remember, you can watch us live in the markets every morning starting at 9:30 a.m. Eastern Time, and we have lots more free trading tools and content available on our website, a1trading.com. Thanks for watching.